Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about the most recent CPI report. We're going to be looking at headline inflation, core inflation, and of course, how it could be affecting things like Bitcoin. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Headline inflation actually came in a little bit above expectations. If you go over to this website, you can see that the forecast for this past month was 3.1% for headline inflation. But it actually came in at 3.3%, which is also continuing. It's a continuation of the prior trend. I think that the thing that the market is trying to wrap its head around right now is that we know the Fed started cutting interest rates in September of 2024. And what you notice is that headline inflation has been going up since September of 2024. Now, ultimately, the market, I think, is trying to wrestle with the idea of, are we going to get a soft landing or a hard landing? We've talked previously about what hard landings could look like, and it could involve the inflation rate just skyrocketing once again. Personally, I hope that doesn't happen. That's not really something that I don't really think any of us want to see happen. I think going to the grocery store and spending twice as much as we were spending in 2019 on the same things is already hard. And I don't really think it would be good for that to even get worse. If you look at the 1970s, just to keep some context, you can see that inflation headline dropped below 3%. And then as we got closer to the post election year, headline inflation started to go back up. And you'll notice that it first started to go up and the market didn't care. And then as it continued to go up, the market started to get a little concerned. And then 1 month it went from 3.8 to 4.8. And then it ended up leading us into a left translated cycle where the peak occurred in December of the election year, or when it happened again in January of the post election year, rather than having a peak near the end of the post election year or the beginning of the midterm year. And so we want to see, obviously, a right translated cycle. But with inflation creeping higher, the market has to ask itself, has the Fed done enough? And hopefully they have. We're going to talk about some of the good things with inflation, even though it's been going back up. But it's not clear yet, right? It's really not clear yet if the Fed has. And that might be one of the reasons why the stock market has stalled out a little bit in recent months, is just simply because inflation just continues to slowly go up. Now, when we think about breaking inflation down by category, we can get a better understanding of what's actually causing this, right? So this is what headline inflation looks like. If you look at like food and beverage inflation, it's going up slightly, but it's still right around 2 to 2.5%. So I wouldn't really consider that concerning. Housing continues to drop. Now remember, housing, I believe, is contributing like 2/3 of overall CPI, like shelter. And so this one coming down is a good thing, but I suppose it's a little concerning that it came down a good amount this past month, but headline inflation still went up. If you look at apparel, it's at 0.5% or so, so well where it needs to be. Transportation has been going up. It's back up to 3%, but my guess is just doing something like what it did over there. Medical care has went back up to 3, now it's falling. That's a good thing. Recreation still below 2, education and communication 0.5, other goods and services also one of the larger categories that's lagged the most, had a nice drop from 3.26 down to 2.38. So we're actually seeing inflation fall in a lot of these different areas. And so while it might look like we're gearing up for another wave of inflation, I don't necessarily know that that's true. One of the things we've talked about a lot is one of the differences is that, back over here in the 1970s when inflation really started to pick back up, it was when the unemployment rate was in sort of a macro downtrend, right? If you were to look at, if we were to go over to the workbench here and add on here a couple of different metrics, like let's add in the inflation rate year over year, and also we'll add in the unemployment rate. So one of the things you'll notice back in the 1970s, when we had those waves of inflation, the wave of inflation that occurred right here was after the unemployment rate had been going down for a while, right? And later in the 1970s, when you had another wave of inflation, it was after the unemployment rate had been going down for a while. But this cycle, while it's true that while it's true that the unemployment rate has kind of stalled out in recent months, it's not like it's been going down for a while. So while it might seem like it's playing out like the 1970s, and it could still seem like that for a while longer, I actually don't necessarily think that's the most likely outcome. I know there's a lot of people that sort of overlay this spike here with this one. And to be honest, they do look pretty similar, right? I mean, you could draw the analog and see that if it just keeps following course, there'll be another wave of inflation. But I don't know. Like, I don't necessarily believe that that's the most likely outcome, as long as the Fed doesn't cave, to political pressures and aggressively cut interest rates more than they really need to. So, I could see a scenario where the market gets spooked that's what's going to happen. But at this point, it's not my base case. It could become my base case, right? I mean, if they cut rates to zero and turn the money printers back on, then absolutely it would be my base case. But it just seems like it could be the market's initial reaction to the rate cuts. But if you look at expectation for future rate cuts, they're just getting pushed further and further out, right? The market right now doesn't even think we're going to have another rate cut until the end of October. So, I mean, it makes sense to see inflation go up a little bit as the Fed cuts rates, but I don't necessarily know that it's going to see a major spike in the same way. Now, that doesn't mean you can't get a spike in the unemployment rate at some point. There's two macro things you have to manage, right? You have to manage the inflation, and you have to manage the labor market. And they're hard to manage together, because as inflation goes up, you can't cut rates. Therefore, the small businesses that are counting on lower rates, it becomes harder and harder for them, which can lead to layoffs, right? But if there's too many layoffs, then that affects earnings, which would then cause the Fed to then cut rates. The question is do they wait too late? So in this case, inflation, it did come in a little bit hotter than expected. I don't really know that sort of the coming in above expected is a big deal, as it is that it's just been going up since the Fed started to cut rates. And at what point are we going to see this level out, right? We can want it to level out, but how long until there's more evidence that it's actually going to, right? There always exists a scenario where the unemployment rate starts going back down for a little while, leading to more wage inflation, which can then be sort of put pressure on overall headline inflation. But I think that's sort of the reason the market is somewhat spooked, is because really since September, the inflation rate has gone from 2.4 to 2.6 to 2.7 to 2.8, 2.9, and now up to 3%. And if you look at a monthly change of headline inflation, it's been pretty consistent, right? I mean, really since the Fed cut rates right there, the monthly change has been about 0.139%, then 0.143, then 0.158, then 0.127. So it's just slowly going back up ever since the Fed cut rates. Now, one of the things I mentioned is that if inflation comes in hot, then it would likely cause the 10-year yield to go back up. Now, it looks like that's what's happening. If you look at the 10-year yield, it sort of looks like what's happened is the 10-year yield had this area right here that was struggling to break through. It then eventually broke through it, and now it's potentially holding support at that level, which, by the way, happens to correspond to the 21-week EMA. You'll notice similar patterns previously in this cycle, where there were sort of breakouts and then retests of the 21-week EMA. You had one of those basically right here, right? Sort of an attempt to break out, an attempt to break out. And then it finally did, and then it came back down and back tested that 21-week EMA. So you could argue that it's done that a couple of times here, right? Up to the 21-week EMA, up through it, back to the 21-week EMA. Now remember, a lot of times when the long end of the yield curve tops out, it eventually is a sweep of a prior high. And that doesn't even mean that this is the high that it'll eventually sweep. It could be that it goes to a higher high and then sweeps that high later on. But my point is that there's a chance here that the 10-year yield goes back up to 5% and sweeps the prior high from October of 2023. And if you look at if you look at what happened in 06, there was kind of an interesting similarity where you have sort of a peak and then a lower high, and then you sweep that high, go back to the bull market support band, and then you get a big move up. Do you see that? So if you zoom out here, you can see what I'm talking about, right? So you have your initial high. I mean, you could even just expand this line over and see that it's not even that far off from that high right there. And then you have sort of a lower high, right? And then you sweep it, which is exactly what just happened. And then you go back to the 21-week EMA, which is what just happened. And then it goes all the way up here, right? Then the 10-year yield went from like 4.4, which is where it just hit, and it went all the way up to over 5%, right? It went over to 5%, and then eventually it swept that high. You see? And that's what I'm saying, right? Like, there is a chance that this is the high that it sweeps and then it's over. But there's also a chance that if it plays out like, 06, 07, that it could go to a higher high above 5% and then sweep that high later on. I don't, for me, I think a sweep of this high would probably cause enough pain in the short term in risk assets. And, if you're curious how this affects Bitcoin, remember in 2023, Bitcoin was also struggling as the 10-year yield went up. And then Bitcoin began another move when the 10-year yield topped, right? It was right here when the 10-year yield topped that Bitcoin started to go back up again. And so I think, as the 10-year yield was going up, Bitcoin was struggling here, right? As the 10-year yield was going up to 5%, Bitcoin was struggling, which is exactly what's happening today, right? Bitcoin has been struggling as the 10-year yield is potentially making this move back up to 5%. So, it's important to remember that as long as the long end goes up, there's a good chance that Bitcoin can falter and can struggle. Whenever the 10-year tops, there's a good chance that Bitcoin would find relief as long as it's topping for, a reason that isn't immediately concerning, right? Like in October of 2023, the 5-year topped, but it was right around the time that Yellen issued shorter duration than the market was expecting. And it was back then, it was basically just a good reason to sort of look at the market, look at bonds in a different way and say, well, look, yields are probably going to go down here because of sort of the changes in expectations. And that wasn't a bad reason for it to top out. You can have bad reasons for it to top out. I mean, like in 2018 when it topped out, we saw the markets drop a lot. In 2008 when it topped out here, right, or 2007, the markets dropped a lot. But when it topped out right there, the market cycle, the business cycle still wasn't actually over, right? If you look at like the S&P 500, when the 10-year yield put in sort of the first top, it corresponded to a correction, right? It corresponded to a correction, but it wasn't actually like the top. The top occurred when it came back down and then swept the high, right? That's more or less where the major business cycle top occurred. And so that's why you always have to pay attention whenever the 10-year yield is sweeping a prior high. You could almost argue, in fact, it might be prudent to argue this, that if you want the business cycle to go on longer, it might be better for the 10-year yield to go well above this high, signifying that the economy is still relatively strong. If it tops out at that high, then who's to say it's not just what happened right here where, this is your July 06 and then this is your July or your summer of 2007, right? So like this would be October 2023 and then this could be sort of the next one, which then leads into a recession. So you would almost argue that it would be better for it to go well above that high to then say, hey, like the economy is actually stronger than most people give it credit for. That would be an interesting way for it to develop, and I could be on board with that path. I could certainly be on board with that path. It would allow certain things and say like the cryptoverse to catch bids later on this year, if that's the case. Things that have been bogged down for so long, because as we talked about yesterday, right? It seems like most people are either in Bitcoin or meme coins, not a lot in between. It might give that stuff in between a chance to finally make a move that's a little bit more encouraging if the 10-year yield kind of proves that this is not like that level is not actually the top, and then it's just downhill from there. So we'll see what the 10-year yield does. My guess is that as long as the 10-year yield is going up, Bitcoin will likely struggle. Whenever the 10-year yield tops, that's where Bitcoin could catch a bid, so long as it's not topping because we're heading into a recession, right? As long as it's not this type of a top where it just kind of sweeps the high and then goes into a recession. That would obviously not be good. So those are my views right now, though, on the asset class on Bitcoin. And remember, I mean, in terms of thinking about right translated or left translated, in order to get a right translated cycle, you need for the inflation rate and the unemployment rate to be well behaved. You don't want the inflation rate skyrocketing like in the 1970s. You also don't want the unemployment rate skyrocketing either. And so it's a dance that the Fed has to maneuver around, and hopefully they don't mess up one of those two metrics. As long as those two metrics are well behaved, there's always hope of a right translated cycle with a peak later on this year. If either of those two metrics go up a lot, if there's a big spike in the inflation rate or a big spike in the unemployment rate, then the odds of a left translated cycle would go up a lot, in which case, it would take longer for things to get back on track. But anyways, guys, that'll wrap it up for the video. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. See you guys next time. Bye.